Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 275 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, Matt is out of town on business, so you are fortunately or unfortunately stuck with me. We're going to do something a bit different this week in this, what I'm calling a solo-sode. So I'm going to spend the majority of the time discussing the 2025 IRS Inflation Adjustments that just recently came out a few weeks ago. The annual inflation adjustments are updates the IRS makes to various tax-related thresholds, credits, and deductions to keep up with inflation every year. They adjust tax brackets, the standard deduction, retirement contribution limits, and other tax-related figures based on changes in the Consumer Price Index, or CPI. These adjustments help ensure that taxpayers aren't pushed into higher tax brackets solely due to inflation. But before we get to that discussion, just want to quickly review the month-to-date and year-to-date performance of the major market indices that we track. And this data is from Y-Charts and as of the market close of October 30th. S&P 500 index up 0.9% for the month and up 21.9% for the year. The Dow Jones Industrial Average down 0.4% for the month and up 11.8% for the year. The NASDAQ Composite Index up 2.3% for the month and up 24% for the year. The Russell 2000 Small Cap Index up 0.2% for the month and up 10.3% for the year. And the Vanguard All World X United States ETF down 3.9% for the month and up 7.8% for the year. 3-month Treasury rate at 4.67%, the 2-year Treasury rate at 4.15%, and the 10-year Treasury rate at 4.29%. Moving on to big headlines and current events from this past week. Only thing that is noteworthy to share is that we are less than a week away from the presidential election on November 5th, so I wouldn't be surprised to see some volatility come into the market over the next week or so. Especially with some of the largest companies in the world reporting their earnings for the previous quarter. So that's going to be set to happen over the next several business days. Google reported earlier, a bunch of semiconductor names. Apple and Amazon are set to report tonight. So wouldn't be surprised if we got some volatility to come into the market. So moving on to the main part of today's show, which is discussing the 2025 IRS inflation adjustments. So I'm going to talk about what I deem to be the most important adjustments that they came out with. I'm going to give a brief description of each topic that I'm talking about, and then let you all know what the change is for 2025. So first, we're going to start with Social Security's benefits cost of living adjustment, or COLA. Each year, Social Security benefits are adjusted to maintain pace with inflation so that retirees' purchasing power does not erode over time. The Social Security Administration announced this year that there will be a 2.5% increase in Social Security benefits in 2025. So if you are receiving $2,500 per month from Social Security, your monthly benefit in 2025 should jump to approximately $2,562, which is a smaller cost of living adjustment than people have gotten over the past couple of years with inflation getting reined in and coming back down to earth. Next thing I want to talk about is the standard deduction. So the standard deduction is a fixed dollar amount that reduces the amount of income you pay tax on. It's a specific amount set by the IRS that most taxpayers can subtract from their income before calculating their tax bill. This deduction amount varies depending on your filing status. So for example, if you're single or you're married filing a joint tax return, and taking the standard deduction means you don't need to itemize individual deductions, which also just simplifies the tax filing process. So in 2025, the standard deduction is increasing to $15,000 for individuals, which is up from $14,600 today. And it's going to be $30,000 for married couples filing a joint return, up from $29,200 today. Next, I want to discuss the long-term capital gains tax. The long-term capital gains tax is a tax on the profit you make when you sell an asset like stocks or real estate, and specifically for more than what you paid for it. But the key here is that you must have held the asset for more than a year to be eligible to pay the long-term capital gains tax, rather than the ordinary income tax rate. So if you hold an asset for less than a year and sell it at a gain, then that gain will be taxed at your ordinary income tax rate, which is always going to be higher than that long-term capital gains tax rate. So in 2025, if you're single, you will pay 0% capital gains tax if your taxable income is under $48,350 and under $96,700 if you are married filing a joint tax return. I think this is an important provision to pay attention to, especially if you have several assets that have large built-in long-term gains, because at the end of the day, we want to try to sell long-term assets in years where our taxable income is low, so that we can do our best to wiggle our way into that 0% long-term capital gains tax. So it's often very common that people sell long-held assets in their retirement years because they don't have any earned income during those years. Staying on the tax rate conversation, I want to talk about the new marginal tax rates in 2025. So in 2025, the top tax rate is going to remain at 37% for individuals with incomes greater than $626,350 and greater than $751,600 for married couples filing jointly. So essentially, the tax brackets moved up by just under 3% from 2024 to 2025, which is right in line kind of what the cost of living adjustment for the Social Security benefits are in 2025. So the table that Jenna is going to put on the screen now on the YouTube page, which will also be in our show notes, shows the difference between the tax brackets in 2024 versus 2025 for a married couple filing a joint tax return. And this specific graphic is from NerdWallet. So I won't spend time going over reading the 2024 tax rates. I will just briefly discuss the 2025 tax rates, but this graphic will remain on the screen and it will be in our show notes if you want to take a little deeper dive into this. So again, this is going to be tax brackets for 2025 for a married couple filing a joint tax return. So if your income is under $23,850, that's the 10% tax rate. If your income's between $96,950 and $23,851, the tax rate is 12%. The 22% tax rate is between $96,951 to $206,700. The 24% tax rate is $206,000 all the way up to $394,600. The 32% tax rate, $394,601 up to $501,050. 35% tax rate, $501,051 up to $751,600. And then again, like I mentioned earlier, that top tax rate at 37% is for income that is $751,601 or more. So I know that was a mouthful. It's way easier to look at that as a graphic, which we will have available for listeners and viewers. So again, you can just do a quick Google search if you want to take a deeper dive into these tax brackets for next year. Next is the gift tax exclusion. So the annual gift tax exclusion is the amount you can give to someone each year without having to pay gift tax or report it to the IRS. In 2024, you can give up to $18,000 per person per year without triggering that gift tax. And this means that you can give multiple people up to $18,000 each, and it wouldn't count towards your lifetime gift tax exemption or require you to file a gift tax return. It's a very common way to give money or assets to others tax-free within certain limits. And this dollar figure increases to $19,000 in 2025. So just circling back quick, that lifetime gift tax exemption that I mentioned earlier is an amount of money or assets you can give away during your lifetime or as part of your estate without paying federal gift or estate taxes. So in 2024, this amount is $13.61 million per person. So this means you can give away up to $13.61 million in gifts over your lifetime, or through your estate when you pass away before any federal gift or estate tax kicks in. If you exceed this exemption, which is unlikely for most people, any additional gifts or estate value might be subject to a federal tax. But again, just to be clear, this exemption is separate from the annual gift tax exclusion I just discussed, which lets you give up to $19,000 per person per year in 2025 without it going against your lifetime exemption. Next, I want to talk about a couple of tax credits that are important for people to be aware of. But before we get into those, I want to just briefly define what a tax credit is. So tax credits reduce the amount of tax that you owe dollar for dollar. So for example, if you owe $1,000 in taxes, but you have a $200 tax credit, your tax bill would drop to $800. And there's two distinctive types of tax credits: non-refundable credits and refundable credits. Non-refundable credits are credits that reduce your tax bill but only goes to zero. So if you owe $200 in taxes and have a $300 non-refundable credit, you won't owe any tax, but you won't get the extra $100 back. As opposed to refundable credits, which these types of credits reduce your tax bill, and if the credit is more than what you owe, you get the leftover amount as a refund. So for example, if you owe $200 and have a $300 refundable credit, you get a $100 refund check. Tax credits are valuable because they directly cut down your tax bill, unlike deductions, which only reduce your taxable income, like we talked about earlier with that standard deduction. So the first credit I wanted to discuss is the EITC credit, or better known as the Earned Income Tax Credit. So the Earned Income Tax Credit is a tax break for low to moderate income working people, especially those with children, and it's designed to boost income by reducing the amount of tax owed, and in many cases, it results in a refund. The amount of the credit depends on your income, filing status, and how many kids you have. So for example, a single parent with 2 kids who earn below a certain threshold could get a bigger refund thanks to the EITC. So essentially, this is just a way for the government to support working families by giving them a little extra financial help at tax time. So for 2024, to qualify for the credit, your adjusted gross income had to be below $66,819 as a married couple filing a joint return, or under $59,899 if you are single. And for qualifying taxpayers who have 3 or more qualifying children, the 2025 maximum earned income tax credit amount is $8,046, which is an increase from $7,830 from 2024. Last tax credit I want to discuss is the child tax credit, which is a tax benefit for parents or guardians that help reduce the amount of income tax they owe. It's meant to provide financial relief for families raising children who are under the age of 17 specifically. The maximum child tax credit remains unchanged at $2,000 per qualifying child for 2025, and $1,700 of that $2,000 is a refundable tax credit. So no change in the child tax credit for 2025. Last thing I want to discuss is flex spending accounts, and this was a last-minute add-on to this podcast outline because I saw a lot of people talking about it on social media. Flex spending accounts are special savings accounts you set up through your employer to save money tax-free for certain health or dependent care expenses. So you decide how much to contribute at the start of the year, and that money comes out of your paycheck before taxes. So this means you're saving on taxes while setting aside funds for things like medical expenses, prescriptions, or child dependent care. One key rule with FSA funds, though, is they're typically use it or lose it within the plan year, although some plans offer a grace period or allow a small amount to be rolled over to the next calendar year. But FSAs are helpful because they let you use tax-free money for out-of-pocket costs, making these expenses a little bit more affordable. But the interesting part here is the maximum flex spending contribution is $5,000, which from what I could find has not been raised in 38 years. And I just wanted to point this out because, like I said, I saw a lot of people talking about it online, and someone even went ahead and inflation adjusted that $5,000 from 38 years ago, and $5,000 would now be worth $14,384, which is kind of crazy to think about that hasn't been adjusted for inflation, for whatever that's worth. And last but not least, retirement account contributions. It does not look like the IRS has come out with those adjusted retirement plan contribution limits for accounts like IRAs and 401ks. But when those numbers do come out, we will make sure that those limits are shared with listeners ASAP on a future show. So that's kind of a wrap for the IRS inflation adjustments for 2025. We usually take a little time out of a podcast every year to go over these, so I wanted to make sure that everyone was familiar with them. Like I said, hopefully those retirement account contribution limits will come out soon, and we will share those as soon as possible. Just want to thank everyone for tuning in and listening to episode 275 of the Independent Advisors podcast, and we will be back with you next week, 2 days after the election, for episode number 276. Have a great weekend, everybody.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.